Hey, welcome back everybody. You're tuning in to howtoplaystock.com. My name is Kepley. Hope you guys are doing good today. In today's video, I wanted to cover demographics. Okay, now demographics deals with populations across the globe, and they're interconnected and correlated with the stock market. Okay, now there's something really important that you need to pay attention to moving forward over the next probably 15 years when it comes to the demographics. Now, what am I talking about? I'm specifically referring to baby boomers. Okay, now these are people between the ages of, say, like 53 to 65, 70 years old, and you know, a little bit older than that. So today's video, I'm just going to cover the correlation between stocks and the stock market and this older crowd of folks, you know, and the baby boomers who are getting ready to retire, and what you can expect in the stock market moving forward when it comes to playing stocks or, you know, investing in your 401k. So continue watching, and I will see you in the next portion of this video. For today, I wanted to cover demographics, and I'm going to show you what you can expect over the next 15 years when it comes to your long-term investing approach that you take for your retirement. Now, this video is specifically geared towards people who are not of the baby boomers. So if you're a baby boomer, this really kind of excludes you. I mean, it does. You are involved with this, but this is specifically for people who are not in that retirement age and don't have to, you know, get rid of their tax-deferred investments just yet. So back in 1974, something called the ERISA Act was put in place, and this is the Employee Retirement Income Security Act. Now, this is what started the 401k account, okay, that you would get through your employer, so that you can invest and save and build up for retirement, and, you know, hopefully one day retire, you know, wealthy. I like to call these, you know, the 401k, I like to call that the 201k. If you remember what happened back in 2008 with people losing half their wealth in, you know, 401ks because it was tied directly to equities and they weren't balanced for risk parity. If you don't know what I'm talking about, go ahead and subscribe to the channel, because I explain this thoroughly in other videos about risk parity. But that's besides the point. What I wanted to touch on with the ERISA Act of 1974 is that by the age of 70 and a half, by law, the baby boomers are mandated to liquidate tax-deferred assets that they've accumulated over a lifetime, and they have to start getting rid of those. They have to start selling their assets on the stock market. Okay, this would include mutual funds. Now, they don't have to get rid of them right away, and this is where there's a little bit of confusion with people, because they're seeing articles out there that are related to this, and they think that this is all going to happen at once. This is not the case. It's going to happen over the next 15 years, because by law, these people are mandated to start selling their assets over a 15-year time period. So they have 15 years to actually liquidate everything, which means they could sell, you know, portions of their retirement account year by year. So again, though, what this creates is a mass amount of sellers going into the stock market. So simply put, we're going to have more sellers than there are buyers over the next 15 years in the stock market. That will cause a stock market crash. And here's why. Because the Federal Reserve, their one and only job really is to try to control inflation and you know, watch the value of the dollar, either bring it up or bring it down, control interest rates, that kind of thing. So what they'll do, though, in times of economic crisis, they like to fire up the print presses. That's what they've been doing for pretty much the past decade, you know, and keeping interest rates at dang near zero. So what they're going to try to do, though, since we have more sellers that are going to be coming onto the stock market than buyers, they're going to try to prop the markets up to keep it from coming down. That's what they do, okay? They're going to continue doing that through maybe another quantitative easing, round 4, because we've already went through 3 rounds of that. So they're going to try to prop up the markets to keep this thing from really coming down if they can, and that's going to destroy the value of the dollar, basically, because they're going to have to print up more money. Our total country's debt right now is at about $20 trillion. They're going to have to print up trillions of dollars on this next round to keep this thing from falling down. And they've actually set it up by design and mandated it by law that a stock market crash is going to have to happen. Now, John Rubino wrote an article on Zero Hedge about this, and I'll take you in and show you that article. I'll also leave a link for the article in the description below so you can read it. But simply put, get ready, because demographically speaking, the stock market is going to crash. It's going to have to, because you have millions upon millions upon millions of baby boomers that are going to be entering the market and selling. You're not going to have enough buyers coming in to buy up stocks and invest, because if you look at statistics for Americans here in the United States, as of right now, there's roughly anywhere between, depending on the year, 54 to on up close to 70% of Americans who just live paycheck to paycheck and are flat broke. They can't afford to invest. Okay? That's a lot of people. And there's just not enough buyers to match the amount of people that are going to be forced to start selling some of these assets over the next 15 years. There's not enough buyers to balance that out so that you can have a stock market that continues to either stay steady or grow. Okay? Now, if you don't believe what I'm saying, again, I'm going to take you in. I'm going to show you the video, and I'm going to show you the article in this next segment of the video, and I'll show you what I'm talking about. Okay, so we're looking at, I typed in ERISA Act on Google, and this is what came up. The Employee Retirement Income Security Act of 1974 was enacted, codified in part at 29 U.S.C. Chapter 18. It's a federal law that establishes minimum standards for pension plans in private industry and provides for extensive rules on federal income tax effects. Okay, so let's go to the article here real quick. This is by John Rubino, and he goes in and says, basically, while the Japanese and Swiss central banks have turned themselves into hedge funds by loading up on equities, the U.S. Fed has stuck to supporting the stock market indirectly by buying bonds. Alright, it's worked obviously with all major U.S. indexes at record highs, but it won't work going forward thanks to 2 gathering trends. First, the main way bond buying supports equities is by lowering interest rates, which, among other things, allows corporations to borrow cheaply and use the proceeds to buy back their own stock. Companies avoid paying dividends on the repurchased stock, and the government gets capital gains tax revenue from a bull market. From a short-sighted Keynesian perspective, it's a win-win. So they talk about the buybacks. Now, longer term, potentially there's a much bigger problem for equities that can be found in the structured U.S. retirement savings accounts. So John goes on here and he says at age 70, holders of IRAs are required to start cashing them out. And as the number of boomer retirees soars, the size of these equity sales will rise. And then so what he goes on to say here is the required minimum distribution spells disaster and even greater intervention from the Fed. It's like I was saying there. Sellers are going to overwhelm buyers. Simply put, investing for the long term had its time, but that time is drawing to a close. The math is pretty easy. We'll have too many sellers and too few buyers. Why? He asks. At age 70 and a half years old, retirees are mandated by force of law to sell tax-deferred assets accumulated over their lifetime and do so in a 15-year time frame. Conversely, buyers incented by tax deferral but not forced to buy by law generally have a 30-year window of accumulation. Over the past 65 years, on a population basis, there were 3 new buyers for every new seller. Now, over the next 25 years, on a population basis, there will be 3 new sellers for every new buyer. Okay? So there's the chart for you. And it's pretty much in your face. I mean, what does that tell you? If you got 3 new sellers for every new buyer, the market's going to have to come down. And the Fed, they can try to intervene, like I was talking about, with a QE4 and fire up the print presses. But with interest rates so low, and with the Fed not being able to raise those interest rates without, fearing that they might pop the bubble and pop that bubble as it is right now, they're going to be faced with a serious problem. Because as of right now, you look at the national deficit, we're at almost $20 trillion. I mean, if we so much as raise the interest rates by 1%, we're not even going to be able to pay the interest on that debt. And that's another thing that David Stockman has been coming out and talking about in the last few months, is the fact that, by June, the government's going to be out of money. Okay? They can't even afford to pay the interest on the debt as it is right now, let alone raise interest rates. They want inflation, but they can't do it, because if they do, they're not going to be able to pay the interest on the U.S. government's credit card, basically. And it's just unsustainable. So if the Fed wanted to try to intervene and keep this market from collapsing due to these retirement savings reductions, they're just not going to be able to do it, because in order to fire up the print press and print more money, they're going to have to add to that national deficit of $20 trillion that we already have. And if they do that, well, then you're looking at 21, 22 trillion, whatever that number may be, plus interest. And if you add interest on to a 21 or 22 trillion dollar debt, then we really can't pay the interest on our credit card. Then we're pretty much, it's game over. We're at the end of the road. They're going to have to default on the debt, do a complete demonetization of the debt, basically a reset, and just not pay our creditors. And third option is maybe come out with a new currency that's backed by something, because as it is right now, it's not backed by anything. So I doubt the Fed, though, is going to go for any of this, new currency. They're not going to just throw it out there in front of you and say, here, accept this. You have to take it no matter what. Because their fear is that we'll have a revolution. People might revolt. So I think they're just going to continue doing the same. I mean, this is just my own opinion. And, you can disagree with me if you want on this. Go ahead and share your thoughts on it. Let me know what you think. But, just looking at the scenario and the situation that we're going into here, the only thing I could see the Fed maybe doing is continuing what they've been doing. And that's just fire up the print press and keep printing money. Of course, though, their back's up against the wall, and if they do that, well, they're just going to add to the national deficit. And again, they're not going to be able to pay the interest on the credit card or the interest on the national debt. Which brings you back to right back to square one. You're going to have to demonetize the debt, default on your promises, one way or another, or come out with a new currency. If you like what you're seeing here, go ahead and like the video and share it with others. Let me know what your thoughts are on this. You're tuning in to howtoplaystock.com. My name's Kepley. And remember, guys, income's the outcome. I will talk to you later.